everyone, and welcome to the premium video newsletter for Friday, August 16, 2013. As we anticipated in the beginning of the week, we got some volatility yesterday. Let's start off with the latest news and work our way down from there. And remember, Fridays are either really quiet or really volatile, and we didn't see the volatility today. The morning we started off with the housing starts report, which suggested that home building is maintaining its recovery, but might be starting to be restrained by higher mortgage rates. And mortgage rates are going to go up because interest rates are going to go up. It's just a matter of time. Builders, though, began work on houses and apartments at a seasonably adjusted annual rate of 896,000 in July. That was up 6% from June, though slightly below the expectations of 903,000. Mortgage applications fell 15% since the end of April. Signed contracts to buy homes slipped in June after reaching a 6-year high in May. Another report that was released was the U.S. worker productivity numbers, which accelerated to a still modest 0.9% annual pace between April and June after dropping the previous quarter. Productivity measures output per hour of work. Weak productivity suggests that companies may have to hire because they can't squeeze more work from their existing employees. That is, if demand for a company's product is growing. Productivity growth has been weaker recently, rising only 1.5% in 2012 and only 0.5% in 2011. 3 months of gains in consumer sentiment have suddenly been scaled back sharply, with the index falling 5.1 points to 80, which is far below the consensus of 85.5. This is the lowest reading since April. It also fell below the lowest end of the forecast, which was 82.5. However, much of yesterday's volatility and today's trading is focused on three fundamental factors. The first one is the continuous speculation from the Feds that we've been seeing, which focuses on whether or not the Feds will cut the stimuli program next month. The second major economic factor impacting prices right now is low expectations and numbers from the biggest retailers in the U.S. This is responsible for 70% of the U.S. spending, and the numbers are consistently bad from Walmart and now other retailers such as Nordstrom's as well. And the third and final concern right now is the unrest and violence that's occurring in Egypt. It seems like the violence is escalating to a point where several international companies are halting operations in areas surrounding Egypt. The next question becomes, how does all of this affect the market on a technical basis? Looking at the S&P 500, we did move down to another level. However, the trading action is very different from yesterday, and it doesn't seem like we have much momentum and strength to the downside. This is suggesting that we're going to rally within the next day or so. Further, the broad market is not biased internally, meaning there isn't an overwhelming balance of stocks making highs or lows right now compared to the other side. So unless there are new fundamentals coming out over the weekend that we did not hear about, we should be bouncing back up or at least staying at these levels for the next few sessions. I'm not expecting too much downside right now. I wouldn't be surprised if we channeled a bit between the 1660 and the 1680 level for a few days. As a matter of fact, Nasdaq, which likes to lead the broad market, did not go down today to another low level and is not being pushed down by subsectors like it was last week. The tech stocks are definitely stronger today than broad market, primarily because the tech market doesn't have the weight of the retail sector pushing it down. Just as a confirmation, looking at the semiconductors today, you can see they look exactly like the broad tech market, and it looks like we're going to be filling the gap to the $38 level if things stay status quo. One subsector that is strongly affected by the retail announcement is the retail sector, which made a lower low today. I'm expecting this ETF to move down to the 78 level for now, and we will wait to see how this market responds at the lower level. One subsector that is strongly affected by the retail announcement is the retail stocks, which made lower lows today. I'm looking at this ETF to move down to the 78 level for now, and we will wait to see how it responds at the lower level. If the broad market joins the party, we can see this ETF move to the 78 level, but it won't happen if this is the only weak sector in the group. One last sector I want to look at is the transports, and this is one of the reasons why I think the bears are done for now with the broad market. Even in light of the negative retail story, we're seeing strong upside here, and I think we will go up to the 116 level within the next few days if things stay the same. Yesterday, I discussed the crude oil market at length and talked about how I'm surprised by the lack of volatility to the upside in light of the news we're seeing out of Egypt. Today, I'm even more surprised because the violence and unrest are getting worse, and this can have a major impact on oil prices, but the market is not reacting or reacting very little to this news. What this tells me is unless we see something really unexpected, and at this point, with the Egypt situation, I really don't know what it could be, I'm seeing this market being a little overdone to the upside. It might have been that the Egypt situation caused this market to overreact, but right now, it's not reacting to it at all. The gold market continues its momentum to the upside, and I'm watching the high 1390 level for some resistance to come in. I want to see how the gold market reacts when it gets to the 1390-1400 level and see if it stalls or goes right through it. Theoretically, I think we can go up another 50 to 70 ticks, but I don't think we can muster it on this leg up right now. Let's keep watching the resistance level carefully, and I will update you if we start bouncing back down. Remember, the long-term trend is down, so we have to be careful around these levels. The bond market continued moving lower today, and we came only within 6 ticks of our downside target. Maintain the position into the weekend, and keep a limit buy order near the 124.5 level. Hopefully, it will get triggered Monday morning near the open on a downside move. Technically, the euro looks like we hit our resistance level to the upside, and it looks like we're headed back down to the 132 area within the next few sessions. I don't know if we will go all the way down to the 127 area, but right now, if we break the 132, we will go down to the 130 level, and then we will have to see how the fundamentals are looking. Lastly, the Aussie looks like it's hitting resistance around the 92 area, and I'm anticipating us moving back down to the mid 88 level if we can't break much higher. Whatever you do, do not take long trades in this market. The long-term trend is down, and this rally is not convincing anyone that the Aussie is turning around. If you trade channels, shorting around this area is not a bad idea, but remember, we only take trades in the direction of the trend, and this trend is down. We have a few setups for Monday, but I will discuss them on Sunday afternoon when I do my weekly Outlook video newsletter for you. So stay tuned for Sunday. Have a great night, everyone, and I'll touch base with you Sunday evening.